Welcome to the Deep Dive. We break down complex corporate updates so you don't have to. Today, we're digging into BioHarvest Sciences, that's ticker BHST, and their second quarter 2025 results and corporate update. Now, if you follow the biotech space, you'll know BioHarvest. They've got this interesting dual engine thing going on. You've got the direct-to-consumer side with their VINIA product based on their botanical synthesis platform. And then that same tech is powering this emerging CDMO business contract development and manufacturing.
Right. That dual strategy is really the core of the whole story here. And looking at the market reaction to the call, I'd say it was cautiously optimistic. Maybe bullish is too strong. Management definitely laid out some strong operational progress, good momentum for the rest of the year. But look, there are still financial hurdles they need to clear. The big one everyone's watching is Q4. The
Q4 break-even target, yeah. We'll get to that. But first, let's just hit the highlights from Q2, the scorecard, if you will. Revenue came in at $8.5 million. That's up a solid 41% year over year, and it met their guidance.
Yeah, top line looks good, but the really eye-catching number for me, gross margin, it jumped to 60%. 60%. That's an 800 basis point increase compared to last year. That kind of leap, especially in a DTC business, really points towards genuine efficiency gains, scale kicking in.
Okay, strong revenue, amazing margin expansion. But then we get to the bottom line, and that's where things get a bit more complicated, right? GAAP net loss was $4.0 million, so that's negative 24 cents per share. Adjusted EBITDA loss was tighter, negative $1.3 million. But the non-GAAP EPS, negative 0.15 cents, actually missed the street's expectation of negative 0.11 cents.
Exactly. And that's the divergence you mentioned. Great top line, great margins, but the loss is wider than analysts hoped. So why? Well, it seems like a deliberate choice. Management's investing heavily right now. That wider loss reflects spending on building out the CDMO side, increased marketing for VINIA, and also compliance costs, things like getting ready for a potential NASDAQ listing down the road. If you look at that adjusted EBITDA number, though, it strips out a lot of the non-cash stuff and those one-off compliance costs. It gives you a perhaps clearer view of the core health of the VINIA business itself. That adjusted loss being much smaller suggests the underlying operation is actually quite robust. They're basically sacrificing some short-term GAAP numbers to build longer-term capabilities. It's a strategic play.
That margin story, though, 60%, well, it's fantastic for a physical product, almost like software margins. How exactly did they find those 800 basis points? Where did that efficiency come from?
It really boils down to scale and their tech. Most of it came from using bigger bioreactors, 22% larger, which is a significant jump in capacity. Combine that with just better manufacturing yields, getting more product out per batch, and some digital workflow improvements they've made, optimizing the whole process.
And there was that detail about logistics, too, which I thought was quite smart. Shows real focus on the details.
Yeah, sometimes it's the simple things, right? They figured out shipping 6-month or even 12-month supplies all at once instead of quarterly refills. Just that change in shipping cadence cut fulfillment costs enough to add 50 basis points straight to the gross margin. Every little bit helps.
And it's telling that they've held their pricing steady. $99 for a 90-day supply since, May 2021. In this kind of inflationary environment, holding that premium price point suggests real brand loyalty, doesn't it? Especially while scaling.
Absolutely. No price cuts needed, it seems. And that loyalty shows up in the DTC numbers. They hit 65,000 active U.S. VINIA users as of July. And cumulative revenue since VINIA launched back in 2021 is now over $60 million. Pretty impressive ramp.
The channel mix is interesting, too. Amazon's about 20% of sales, and VINIA is the #1 resveratrol-only product there. That's strong validation.
It really is. And it's smart how they're balancing things. The core capsule business is still the main engine, driving about 80% of the year-over-year growth.
Yeah.
But those newer products, like the DailyChews and the hydration powders we'll talk about, they chipped in the other 20% of growth. So they're milking the cash cow, but also seeding the future.
Okay, so that momentum leads us straight into the back half of the year, and management was very clear about the stakes. Hitting that adjusted EBITDA break-even in Q4 hinges entirely on hitting at least $9.1 million in revenue in Q3. That $9.1 million is the number to watch.
It's the absolute key. Miss that, and the Q4 break-even goal looks shaky. So to make sure they hit it and accelerate growth, they outline these 3 core initiatives. They're big bets, they called them.
Right, the big bets. Let's break those down. First one, the Health Pros Professional Affiliate Program. It sounds like a formalized channel targeting, what, 300 key opinion leaders, doctors, nutritionists, top athletes by year end?
Exactly. And the key here is the type of affiliate. They're not just looking for influencers posting selfies. They want an educated sort of technical sales force. The idea is if you're a doctor or a nutritionist who actually understands the science behind blood flow, recommends VINIA, that customer comes in with a super low acquisition cost, likely stays longer, higher lifetime value. It's about swapping broad, maybe less efficient marketing spend for a targeted, science-backed channel.
Okay, that makes sense strategically. What's the second big bet? The hydration solution entry. They're launching a VINIA-branded electrolyte powder mix in October, targeting the hydration market. That sounds like a tough fight. I mean, isn't that market incredibly crowded, dominated by huge brands with massive marketing budgets? How can VINIA realistically compete just by adding a blood flow angle?
That's a fair question. It is a crowded space, no doubt. But their strategy seems to be about differentiation, not just competing head-on price or existing benefits. They're hitting two angles. One, the unique selling proposition is blood flow enhancement, which most electrolyte drinks don't talk about. Two, they're positioning it as premium and natural, using ingredients like Irish sea salt, coconut water potassium, magnesium from the ocean bed, and keeping it low-cal, only 25 calories. So they're aiming for maybe a different consumer, someone younger, active, willing to pay more for clean labels and added functional benefits beyond just basic hydration. It's about expanding their market.
All right, interesting angle. Let's move to the third bet, which is all about the CDMO side, the AI-enabled CDMO discovery phase. This is a new service they're offering, a billable one, like $35K to $50K for a quick 7 to 10 day project.
Yeah, this one's quite clever, I think. It basically acts as a paid entry point, a high-margin filter for their CDMO pipeline. BioHarvest uses its own AI and computational biology tools to help potential partners. Could be pharma, could be nutrition, cosmetics, quickly screen botanical compounds they might be interested in developing.
So partners pay BioHarvest a fee to help them figure out if their own R&D idea is worth pursuing further using BioHarvest's platform.
Precisely. It de-risks it for the partner. And for BioHarvest, it's brilliant. It's a funnel. They get paid up front for this initial discovery work, and the companies willing to pay are likely serious prospects for larger, long-term, stage 1 CDMO contracts. They're essentially getting paid to qualify their own leads.
Okay, and speaking of the CDMO, it's not just potential anymore, right? There was real progress reported this quarter.
Absolutely. Big validation step. Their first CDMO project, a pharma program for an already approved drug, successfully moved into stage 2 development. Moving to stage 2 is critical. It means going from lab-scale proof of concept to figuring out how to actually scale up production reliably. That's a huge de-risking milestone for their whole platform technology.
And they also signed a completely different kind of deal, highlighting the versatility, something in fragrances.
Yeah, a new contract to produce a specific fragrant molecule. Apparently, it comes from an endangered plant, making it hard to source ethically or sustainably otherwise. This really shows the platform isn't just for health products. Fragrance ingredients like this can sell for thousands of dollars per kilo. It opens up another potentially very lucrative vertical for them.
And management sounded positive about the overall pipeline, spanning pharma, nutrition, fragrance, expecting more deals announced later this year.
That was the message. Pipeline is healthy, multiple deals expected in the second half. And if you zoom out, connect the dots, you see the long-term vision taking shape. The VINIA DTC business generates cash and proves the tech works at scale. And that cash supports building out the CDMO arm, which has the potential for much higher margins, milestone payments, IP leverage. That's the platform company pivot.
Good point. And one last check on operations. They mentioned the Israel to U.S. tariff, that 15% impact. They confirmed they're managing it, absorbing it through other cost savings.
Yeah, they adjust that. Said cost discipline in other areas is offsetting it. That's important because it means that tariffs isn't suddenly going to derail their Q4 break-even target, keeps that goal credible.
Okay, so for listeners tracking BioHarvest, wanting to see if this strategy plays out, what are the key things to watch for in the next, say, 3 to 6 months? The near-term catalysts.
All right, several concrete things to keep an eye on. First, that Health Pros network. Are they actually signing up those 300 affiliates by year end? We need to see progress updates. Second, market reaction to the new products. How are the DailyChews 2X doing? And critically, how does that hydration product launch land in October? Watch the initial sales reviews. Third, look for those first revenues from the AI discovery service. Are companies actually paying for that initial engagement? Fourth, official announcements of new CDMO contracts. Need need to see that pipeline convert. And maybe the biggest catalyst of all, the Q3 earnings report. Does it hit that minimum $9.1 million revenue number? That's the gatekeeper for the whole Q4 profitability story.
Right, which brings us nicely to our final segment, not financial advice, where we float an outrageous but plausible trade idea based on everything we've just discussed.
Okay, let's do it. And the usual disclaimer, this is absolutely not financial advice. Do your own research. Microcap stocks carry significant risk. All right, so the trade idea here, given how much hinges on Q3 and the Q4 target, is a long position held through the Q3 earnings release. Why? The thesis is built on the potential compounding effect of those three big bets we talked about. Management didn't just give vague promises. They gave specific, trackable goals. 300 health pros, the hydration launch timing, the AI discovery fee starting to come in. These are things we can actually monitor. So the thinking is, if that Q3 report comes out and they don't just meet the $9.1 million guidance, but actually beat it, maybe showing early traction from one or more of those initiatives, then the stock could really move significantly because the market would likely start pricing in not just Q4 profitability, but also the validation of the whole CDMO model much more aggressively. It could shift the perception from, just another volatile consumer microcap to something more like a genuine IP-driven platform company. High risk if they miss Q3, obviously, but the potential upside if they deliver could be substantial.
It definitely feels like BioHarvest is at a crossroads, doesn't it? A potential major turning point, financially and strategically, driven by those VINIA margins and the promise of the CDMO business finally kicking into gear.
It does. It really feels like an inflection point is near. But the long-term success, especially on the CDMO side, really depends on just how versatile that platform proves to be across different industries. Which leads to a final thought, maybe something for you, the listener, to ponder. Over the next year or so, where will the biggest surprise growth come from in that CDMO pipeline? Will it be pharma, standard nutraceutical ingredients, or maybe that high-profit niche fragrance and cosmetic sector? Which vertical will really take off first?
An interesting question to leave things on. We'll let you chew on that. Thanks for joining us for this deep dive into BioHarvest's Q2 update.